Welcome to Euros Hartley's Finding the Front, where we get to know the people who front some of Western Australia's leading companies, providing you with real insights into the way they think and approach things, both in business and in life. So get the volume adjusted in your car or your headphones sorted and settle in for a great story. Here's your host, Tim Banfield.
Hey everyone, and great to have you back for another big episode of Euros Hartley's Finding the Front. For those of you who aren't familiar with Euros Hartley's, we are a proudly Western Australian diversified financial services company. We specialise in the provision of private wealth management, corporate finance, institutional sales and targeted research services. If you'd like to learn more about Euros Hartley's and the services we provide, please don't hesitate to contact us or visit our website at www.euroshartleys.com. Well, our special guest for this episode is highly regarded Sydney-based fund manager Chris Stott. Chris earned his stripes working for some 12 years with funds management luminaries Geoff Wilson and Matthew Kidman and the team at Wilson Asset Management, the majority as Chief Investment Officer and Portfolio Manager, responsible for managing the investment team and overseeing the investment portfolios. He did well. So much so that in 2014, the Australian Financial Review named Chris as one of the 5 best young fund managers in Australia. In 2019, Chris co-founded 1851 Capital, leveraging his 22 years' experience in the Australian funds management industry, and kicked off his one and only fund at the start of February in 2020. Well, with COVID, unbeknown to Chris, literally around the corner, timing was everything and provides for a fascinating insight into how it all unfolded. Chris is also Deputy Chairman of the foundation of his beloved Sydney AFL team, the Sydney Swans. This is captivating. So without further ado, it gives me an enormous pleasure to introduce to Euros Hartley's Finding the Front, the co-founder of 1851 Capital and all-round great guy, Chris Stott. Welcome, Chris, to Euros Hartley's Finding the Front. It's so good to have you over in the studio on a brief trip to Perth from Sydney. It's great you could squeeze us in and spend some time. So thanks a lot for joining us.
No, thanks, Tim. Pleasure to be with you today.
Good on you. So, Chris, it goes without saying, but you're an accomplished fund manager. You've established your own company, 1851 Capital, based in Sydney back in 2019-20, and after some 12 years at Wilson Asset Management, which I'm sure you learned a lot as Chief Investment Officer there and working with Geoff Wilson. But we'll get into that. Before we start, it's one of the key points of Finding the Front is just to learn a little bit about your background and your upbringing and how that's shaped you. And just a bit of research, you grew up in North Sydney.
Yeah, on the northern suburbs of Sydney is where I grew up, Tim. Really enjoyed that. 2 younger brothers, so the eldest of 3, Peter and Jonathan being my 2 younger brothers. So we were, we're pretty competitive. Family, lots of cricket games in the backyard and lots of broken windows as a result of those cricket games. But so it was a great upbringing and very grateful for it.
And what did your mum and dad do?
Yeah, so mum was a registered nurse. She moved eventually into a role with Douglas Hanley and Moyer Pathology, which is now owned by Sonic Healthcare. Yeah. So she ran an area within their pathology business for over a decade, which was terrific. And Dad was an accountant, practicing accountant.
That's interesting. Your dad was an accountant. Did you take anything from that in terms of business or figures, numbers?
I was probably too young to know much about it, Tim, at that stage. Yeah, but certainly there's a strong history of that in the family in terms of being in the finance and accounting industry. When I look across all my relatives, there's certainly a good representation across the board.
And so you ended up at school at, I think it was St Ives?
St Ives High.
Yeah. And tell us a little bit about that. Did you enjoy school?
Loved it, yeah. I mean, I was pretty lazy, to be honest. I didn't really work that hard until I had the chat from mum in going into year 11, but now's the time to knuckle down. So I tried to do that and got a reasonable mark. I wasn't a straight A student by any means. Going through those later years, like a lot of people, you go through school and you're not really sure what you want to do once you leave school. And I was in that bucket as well. I had no idea what I wanted to do. And so, I kept the HSC subjects as broad as I could to give myself flexibility for what came after that.
So without knowing what you wanted to do, keeping your options open, you went on and did a Bachelor of Business.
I did.
Yeah.
Yeah.
And that was, you had at least an affinity towards that pathway.
Yeah, and that was really, I was guided to that by my uncle Ian Mason, who was a stockbroker for many, many years, a very successful stockbroker in America and Australia.
Right.
And he was great in terms of mentoring me through, at that age, coming out of school, not knowing, as I say, what I wanted to do. And he said, well, why don't you just go and do a Bachelor of Business, and you can take that many different ways, which I did. And so still in the first year at university, I had no idea what I wanted to do, going through all the business subjects and, finance, accounting, marketing, and what have you. Statistics, which I just hated, like a lot of us. But yeah, eventually it came to me that finance was an area that I was interested in, and sort of pursued it from there.
Well, you sure did pursue it, but in the meantime, during uni, you managed to get a job at JB Weir. Now, that's pretty pivotal. I know you also managed to get a job at McDonald's.
I did. I worked at McDonald's, so from 14 to 9 months all the way through. Worked my way up to end up being a manager. So I was running one of the stores in Sydney in St Ives for a few years part-time, which was in adjacent to uni before I took on that role at JB Weir in my final year of studies at university, which was fantastic. Learnt so much, and JB Weir obviously highly successful business in its own right.
So how did that role evolve? What did you take out of it? When you're at uni and you're doing it part-time, they've given you an opportunity to just come and learn the ropes. But what did you take away?
I learnt so much. It was just terrific. So working in the mailroom, sorting mail, to sorting filing, so sitting on the trading floor and for the legal team and just sorting out some of their documentation, which was really quite interesting. I always I could go in at any stage of the week, any time of the week, and do that. And so I always used to go in at 9:30 on a day I was free, because I loved to see the market open. And all and what happened through that process, and just the noise and atmosphere you get on a dealing or trading floor was fascinating for me at that age, and learned a lot. So really grateful for that experience at JB Weir, and certainly learnt a lot in that 12-month process there, 12-month tenure, at JB Weir than perhaps I did at uni.
Well, what a way to learn. Did you develop a love of the markets? What did you just take away from that going, this is what I want to do?
Yeah, it was probably something that started a few years before that. So, when Mum was working at Sonic Healthcare, I was saving up for a car, as a lot of us do when we're 17 or 18 on our Ps.
Yeah.
And I'd start investing. I started investing some money. So, very small amounts, $1,000 in someone like Burswood Casino, great Perth business, or E-Trade. I had some Sonic Healthcare shares as well at the time. And particularly with Burswood and E-Trade, those stocks I held, and within 12 months they were both taken over. And I thought, this is a bit of fun. I've made a bit of money here, and it's helped me buy my first car. And that's sort of how it came about, and I got the taste for it. Yes. And then to go and sit on the trading floor at JB Weir and get a deeper understanding of how it actually works, as a young 20-year-old was a really
pivotal point.
It was really, and the people that worked there were terrific, great personalities, and really helpful in terms of helping me learn.
Well, it was the background to where you just started your career, really. When you finished your degree, you got a job with Challenger. Now, Challenger ended up being quite a significant funds management business over time. Tell us a little bit about your role there and how you started, and what did you actually consider staying with JB Weir to go on and be your own stockbroker or financial advisor?
One thing that became clear to me through the time at JB Weir was I'm probably more of an introvert, believe it or not.
Yes.
But, so I just didn't feel like I had the right personality or value set to be a successful stockbroker over time. So through that year at JB Weir, it made me realise that probably a buy-side role is something that I'd be more suited to. And so the role at Challenger came up, which I did for a few years. Started out in the back office. If you listeners remember, it was a significant time of upheaval at Challenger at the time when I joined there. I think it was 2003. Bill Ireland was the CEO at the time.
Yes.
And Challenger had gone through a rocky little period. And what had happened was a lot of the team from Colonial First State, the highly successful Colonial First State going through the 90s and early 2000s, a lot of the team came across, led by Chris Cuff, Rob Adams and the like. So there was a significant amount of change going on at Challenger at the time. So I learned a lot through that process as well. But yeah, that initial role was fantastic. Again, providing me good grounding for just understanding how a funds management business works.
Yes.
Working in the back office, processing applications, redemptions, and reconciling and the like. It was good grounding. Really enjoyed it.
Did you analyse companies through this role eventually? Like you started out in the back office, but then started to progress into having a pivotal role in the investment side?
Yeah, so over time, I moved into more a middle office role, which was not analysing companies directly, but essentially working with the investment team. So I was led by Peter Greentree at the time, the Australian equities business.
Yes.
And working with some of his analysts and producing marketing reports and the like, and working with guys like Michael Courtney, who ran their small cap fund for many years, terrific guy, and getting a deeper understanding of the stocks that they own, why they own them, and then it was my job to put that in a form and communicate that to our investors. So certainly didn't get progressed to a front office role in a Challenger, and that was probably the time where I thought, okay, time to look elsewhere.
Right.
After that.
Yeah, because you were there for 4 years.
Yes.
Or nearly 5 years, actually.
That's right.
Yeah.
Mm.
It's interesting, the one thing I took out of that role at Challenger, and we were talking a bit about this offline, but Chris Cuff arrived on the scene at 2003 as CEO and then went from Group CEO into running the wealth management business of Challenger and grew it from $3 billion to some $12 billion, making it a real player. Chris ends up becoming quite a pivotal, or should I say not pivotal, but more of an influential person in your life over time. But it's not there that you really connected.
No, so Chris, highly successful executive in his own right through various companies over time, was just quite extraordinary what he's achieved.
What he did at Colonial was unbelievable.
Well, built it from scratch to being the biggest and most successful fund manager in Australia.
Yeah.
So quite extraordinary to him and his team. So full credit there. But no, certainly. So Chris was the boss, and I was at the bottom, and so we didn't really cross paths as much in that time at Challenger. But certainly, he's become a close friend of mine, a good mentor for me personally, and a great supporter of our business today.
Yeah, absolutely. Well, the Challenger part obviously reached an expiry date, and you had an opportunity to then go and join Wilson Asset Management. How did that come about?
Yeah, it was interesting. So firstly, I did apply for a front office role at Challenger. They were recruiting for a junior analyst, and I got down to the final two and just missed out. And so I thought, okay, that was around the time when I decided, okay, I'm pretty clear about what I want to do now. I'm interested in pursuing this career in funds management. And so I started looking elsewhere, and as we normally do, if you remember, you pick up the Friday AFR and all the job ads are in there. And so I'd flick through them, and one Friday, a job ad popped up for Wilson Asset Management. So I thought, this looks interesting, looking for a junior analyst. They're a smaller outfit, around 300 or 400 million of funds under management. That'd be a great place to learn. And so I applied for it, and the rest is history.
The rest is history. So you ended up getting the job. Did Geoff interview you?
And Matthew Kidman as well.
And Matthew Kidman.
Yeah. So there were a few interviews through that process, but that was certainly a fun experience to go through the interview process with both Geoff and Matthew, who have both been highly successful and continue to be so.
Well, it played obviously a hugely important part of your formation as a fund manager, but also in your life. Tell us a little bit about working there. I mean, you ended up there for 12 years, 8 of which you were CIO or Chief Investment Officer, and the funds under management, as you highlighted, started around 300 million, and through that period rose to something like $3 billion. The business itself expanded into large caps, micro caps, and across global equities. What a meteoric rise, and what a great thing to be a part of.
Oh, I was really, really lucky to be a part of it. And, Geoff and Matthew gave me my start in this industry, and I'm forever grateful for that. But it was certainly an interesting period joining there in 2006, raging bull market. Resources were absolutely flying. I learned a lot through that process in that first 12 months. And LICs, WAM still run a bunch of highly successful listed investment companies here on the ASX. And a lot of them were trading at big discounts to NTA at that time.
Yes.
They were not flavour of the month at all. We had various funds trading at 30% discounts to NTA. I remember attending, this was a fascinating story, in 2007, in November of 2007. So if you remember, that was the top of the market.
I was going to say market is all-time high.
Right at the top.
Yep.
And the fund was racing away, and we'd never really had a big focus on investing in resource companies. And one of our investors got up at one of our briefings and said, "Oh, you guys are mad. Why aren't you investing in resources? You've missed out on all these gains. This stock's going from here to here." And that was the peak. And so we stuck to our knitting, and going through that GFC process, it was just an extraordinary period for everybody that can remember.
Yes.
Going through that in markets, and just so many lessons through that period that I continue to go back to today.
You're obviously an experienced manager of money. And that period of time, 2008, everyone will remember who was in the markets. But tell us a little bit about A, the pressure, B, the mindset, and how you navigate a period like that because it happens again, right? And this is where experience is accumulated. But tell us a little bit about what you took out of that period of time and having a guy like Geoff there to bounce things off.
Yeah, and Matthew as well.
And Matthew,
both of them terrific fund managers in their own right. And some of the key lessons. I mean, obviously the old adage is markets you go up in the elevator and come down the lift.
Yes,
and that was certainly the experience in the GFC. Some of the other key lessons investing in that small cap end of the market is just liquidity, and the importance of that, and which sort of shapes what we've built with the fund today, which I'm sure we'll get to. But just liquidity just dries up in small caps so quickly, and it's really, really important that you stay as liquid as possible. Always have a little bit of cash up your sleeve for a rainy day, such as that. Well, I wouldn't say that was a rainy day. It was a pretty bad storm in the GFC. Yeah. But liquidity is king, and just when you're seeing maximum fear on the street, that's always the time you want to buy.
Yes.
Someone asked me this a few months ago in April when we were having the tariff tantrums in 2025, and they said, is the market a buy yet? And I said, I don't know, but I see things, and I see things like when you're watching the 6 o'clock news and the lead story is, the share market's just lost $100 billion of value and it's crashing, and that's always generally the time you want to be putting money to work.
Yes.
And so going through that GFC period where it was maximum fear and panic, particularly in that month of October 2008 when Lehman Brothers went under, they're typically, if you take a 5 to 10 year view, they're generally the best times to buy through a cycle.
It's easy to say that.
It's very easy to say it, but it's so hard to do it in practice. And we make mistakes all the time and get it wrong. Yeah. And we try and have more that go right than wrong. But it is... You almost want to feel sick when you're buying shares in those periods. Like it just doesn't feel like it's the right thing to do, but it is. Everyone's telling you shouldn't be investing and you shouldn't be buying right now, but generally that's the best time you want to be doing it.
That's exactly what I was trying to understand. Is did you learn that through that period of time from the likes of Geoff and Matt? Saying, Chris, just hold your line. There'll be a time when we have to start buying. Yes,
and Geoff and Matthew were terrific in that period. They had, through the latter stages of 2008 and early 2009, and from memory, the market bottomed in March of 2009. They would invest. We held 30 or 40% cash at some stage, got out to over 50% cash at one stage, and Geoff and Matthew would selectively deploy money, particularly in those big down days, in highly liquid, large caps. So the banks, Macquarie Bank, things that we thought when the market rallied, what's going to have the most amount of leverage coming out of that? So it's typically the financials is where you want to hunt in those scenarios. And so Geoff and Matthew had 2 goes at it, ran a bunch of positions with stop losses on them. The first 2 times they didn't work, but the third time they got it right. And it was right. It was about a week after the market bottomed, and the rest is history. And the fund had experienced some great returns after that in 2009.
The other point you made there is small caps and liquidity. When did you start to lean towards small caps as your favourite investment vehicle?
Through that period at Wilson Asset Management,
yes.
Really. I mean, I think the great thing about small caps is you get exposure to so many different sectors and growth companies. Typically, the top 100 companies in Australia are more mature, larger businesses. They're not as fun to analyse and to look and to meet with the individuals you meet with. It's fascinating, the good, the bad, and the ugly in terms of the CEOs that you meet with over time. And it's really, we're quite privileged, obviously, to be a steward of managing people's money, but also to have access to meeting with a lot of these high quality CEOs, CFOs, where you can just learn so much about different businesses, different industries, and what makes people tick.
Did you learn the art of a CEO meeting or a company meeting through Geoff and Matthew?
Yeah, absolutely.
What questions to ask? How to get to the bottom of where they are at? Tell us a little bit about that process.
Yeah, particularly with Matthew. So before he joined Wilson Asset Management, he was a journalist for the Sydney Morning Herald. So he had that natural intuition and thirst for information and to learn about a business. And some of the things that they would be quite big on, everyone talks about cash flow, but we'd go through the accounts line by line and just get a deeper understanding of what's going on and the moving parts within each business. But also, more importantly, trying to understand what are the personal motivations for a management team. And people talk about this, but it's the incentive structures in particular, the short and long-term incentives that are put in place. And, as they say, show me the incentives, show me the behaviour.
Yes.
And that's really held true, I think, for my almost 20 years of doing this. It's a really underrated piece of research you can do quite simply just by picking up an annual report and having a conversation with a management team. So they were probably, that was probably one of the largest areas of focus for Geoff and Matthew, was understanding what's motivating this team, and where are they going to take the business over time. And they were really good at asking the same questions every time they met companies.
Right.
For an example, remember ABC Learning Centres with Eddie Groves?
Yes. Very
successful business until it wasn't. It went under, through that period in the GFC. But Matthew was great. He would always meet with Eddie Groves, and I'd sit with him and he'd say to Eddie, okay, Eddie, what should we be looking at? What's the most important driver of your business as a childcare centre business? He'd say, well, the main thing you need to ask me is what are the occupancy levels of our centres? Essentially how many kids are in the centres and the operating leverage that creates from that. And so Matthew would meet with Eddie regularly. What's the occupancy levels? How are they going? And then one day Eddie turned around and said, well, no, Matthew, you don't need to worry about that anymore. And Matthew's like, well, what do you mean? You've just told me a few years ago I should always ask you this. And Eddie's like, well, no, we're a much bigger business now. We're diversifying overseas. Where it's not as relevant anymore. And Matthew walked away from that thinking that was one of the biggest red flags he's ever seen, and sold every share he had. And that was the right call.
Yes. Wow. You can just tell by your body language you love what you do.
I do, yeah. It's fascinating. We really, as I say, we're privileged to do what we do, and you just learn so much every day, which is fantastic.
Chris, just tell us a little bit about also Geoff and his following through the investors.
Geoff's, in addition to being a terrific fund manager, has built an incredibly successful business.
Yes.
In Wilson Asset Management, and it was a privilege to work there for the period I did and learn so much off Geoff and Matthew through that 12-year period. But certainly he's, if not one of the best marketers in our industry in Australia. And so I would quite often present alongside him and Matthew at our shareholder briefings right around the country, where you'd have anywhere from 500 people to 1,000 people turn up at the various convention centres around the country. That was at the end. But when I started, we'd even turn up to places like Adelaide, and one presentation we did, we had 3 people turn up. And Matthew and I said to Geoff, well, why are we bothering with this? There's only 3 people. We've flown to Adelaide and there's only 3 people. We shouldn't come back. And Geoff, to his credit, no, we've got to keep coming back.
Yes. And
so we did. And, 6 or 7 years later, we had 400 people in Adelaide turn up.
Yes.
And so, Geoff's ability to relate to people, to present what he thinks are the key issues and to fight for his shareholders is first class.
We had him on the podcast as well, and he was so generous with his time and his insights. And I could imagine working with him would keep you not only informed and educated and building knowledge all the time, but also entertained.
Very much so. He's got a wicked sense of humour. Yeah. And I'd also say one of his great strengths is his calm in a crisis.
Yes.
So that was the other thing I'd say, going back through that GFC period when there's ultimate panic and fear on the street. Geoff had been through the 87 crash and previous market cycles, the tech bust in the early 2000s. So be able to watch how Geoff and Matthew navigated that period was certainly provided some great lessons for me over time.
When you were appointed Chief Investment Officer for Wilson Asset Management, it must have been a very proud moment, I would have thought, and a significant moment, because it enabled you a platform to continue to grow and almost provide a pathway for yourself to learn and develop.
Yeah, it was quite humbling. I was only 31 when that opportunity arose, and so it came a lot earlier than I had anticipated. And certainly it was if you remember, it was at the time where LICs were just starting to turn the corner, and that there was, for the first probably 4 or so years of my time at WAM, LICs weren't the favoured structure from an investment perspective, and then they became into vogue. I remember we did one of the first capital raisings for WAM Capital in 2012.
Yes,
which was very successful, and that started the lick boom for the following 6 or 7 years,
yes,
where the number of LICs listed on the ASX doubled over that time. There were billions and billions of dollars of money raised, and it was certainly as Geoff used to call it, the golden period for LICs. And it certainly played out that way. Our funds under management quite quickly went from 300 million to almost 3 billion when I departed the business in late 2018.
Yes. And as CIO, you were able to navigate that pathway for the business.
Yeah, and I think the key for any highly successful funds management business is the people.
Yes.
And working with high quality people where you share the same values and you stick to the process and you've all got strong belief in your investment process. So I think that's proved to be a really critical part is the team we had at Wilson Asset Management. They continue to have today, continue to produce some outstanding results.
That period of time clearly went fast, and you ended up getting to a point, I'd say not similar to Challenger, but you were seeking something a bit more and decided to finish up with Wilson Asset Management and have a break. Now, that's a pretty sliding door moment in your life, and I just wanted to maybe delve into that a little bit in terms of where did you get to? How did Geoff take it when he said you were leaving? Because I understand he had to resume being the CIO.
Yes.
He got back on the tools.
He did.
And you went out and sort of worked out, or probably wanted to work out a bit further as to what was the next stage for you.
Yeah, and at that point I still didn't know what I wanted to do. And it'd been a highly successful period at Wilson Asset Management. The business had grown dramatically, as I said, from 300 million to over 3 billion at the time. We went from 6 employees to I think we had maybe 30 of them at the time when I left, or 30 or 40 people. So the scope of my role grew dramatically over that time, and it was a really terrific period to be involved at the business and also in the LIC industry, given the growth it was experiencing. And certainly, but when I reflect on it now, I love what I do, and I love the stock market and what it brings every day and the challenges that it brings every day. But through that process, you only realise when you step out, but I was totally burnt out coming out of that role. And so I needed a break, and I absolutely didn't know what I wanted to do. And I thought, if I can take a year off, spend some time with my kids that was quite young at that time still, and reflect. And that year off was just one of the best years of my life.
Yeah.
Where you had the flexibility to do whatever you like. I did some amazing things, lots of travelling, walking the Kokoda track, which was a terrific experience. My grandfather fought up there in World War II, so to learn more about his path through that process was terrific, and also forced myself to get really fit again.
Yes.
Which was great, which I had the time to do clearly through that year off. And some of the advice, great advice I had through that year was, I remember speaking to Andrew Pridham, who's the chairman of the Swans and runs MA Financial these days, and he said he'd gone through a similar period back in his career, and he said, whatever you do, try and have some structure in your year off. Try to have some clear plans and goals about what you want to achieve with that time off. And that was certainly something I carried through that period and was really, really helpful getting through that year.
Did it take you a while to decompress?
About 3 or 4 months.
3 or 4 months, yeah.
And then I started to get a bit bored.
Yes.
And then I'd start trading the stock market again. Yes. And so I'd just personally be trading, positions and the like. And that's probably at the moment I realised that I want to step back into a role in the funds management industry, and then what does that look like? And then went from there.
Were you in a position at that point to think, well, I could probably just run my own money for a while? Is that the way you were sort of thinking at the start? Taking the pressure out of it a little bit, but just doing what you love? Yeah,
that's right. And I think it's a big leap to take in terms of having the confidence to go out on your own, which I've ended up doing. I was very, very lucky to have, some significant figures in my life like Chris Cuff and the like to encourage me to do that, and were very, very supportive. And also through that period, just the amount of, relationships you form in this great industry and meeting with all those different people and building the confidence to do what I've ended up doing, which is helped building 1851 Capital today, certainly was quite pivotal through that year and gave me the confidence to go out and say, okay, we're now going to launch a fund and give it a go. So we did.
There's a little bit more to life than yourself and running a fund. Tell us a little bit about the role family played in that. You've got the 2 kids, which you're obviously just stoked about, I can tell. Your wife. Did she say, look, I'll back you in? Or darling, like, I actually need you to get some money?
No, she was terrific, backed me in 100%.
Yep.
Just do what you want to do. If you believe it can work, then go for it. And so she was terrific. But also, the kids were a big influence as well.
Yes.
And so not everybody, and I was very lucky enough where I was in a position where I could take that year off work and spend some, valuable time, with Edward and Abby, my two kids.
Yes.
Who are now 13 and 11, so they're growing up quickly, as they do grow up very quickly. And so, certainly that was just a terrific opportunity to spend some, really quality time with them, and just as they were venturing off to school.
Fantastic. It's such an interesting this part of your life, because you ultimately did decide, I'm going to start my own business. Now, that comes with a few questions. Firstly, it's nice to be able to start your own business, but you've got to be able to raise capital to start it. How did you go about that first raise? Because you often talk to fund managers who've had to scrap and scrape and try and find every little dollar in every nook and cranny to try and get off the ground. Was it easy, or did you find it tough?
Very tough.
Very tough.
By far and away, the hardest part about building a funds management business is raising the money.
Yes.
And I sort of knew that going in. But as I said, over that year off, I had a lot of people say, well, what are you going to do next? And I said, oh, well, I'm not sure. But I said, well, if you're going to start up a fund, I'd give you some money to manage. And so those conversations accelerated through the year I had off, which gave me the confidence to try and raise some money and get going. What we did was, I remember in my year off, I was lucky enough, I'm a big cricket fan, and I was lucky enough to go and watch the Ashes over in England. And I was sitting there in Lords. One of my lifelong dreams is to go and watch a test match at Lords, which is just brilliant. I've been back there since with my son, which was just a great experience. But anyway, a journalist rang me whilst I was at the cricket and said, oh, I'm hearing that you're going to start this fund. And I said, I haven't talked about anything yet. And so something got leaked to the press, and then the phone started ringing, and then people said, oh, if you're going to start up, I'm interested in this and that. So I started forming a list of people that I'd spoken to, and we ended up creating just a basic website that said, if you're interested in this, sign up here. So people registered, and we ended up building, a list of, a couple of thousand people, which was quite amazing. I couldn't believe it. I was genuinely blown away by it. And so that was the list we started with to go and essentially raise the money.
A couple of thousand. Gosh, that journalist did you a favour.
Big favour. Yeah, no, absolutely. And so that gave us the base to go and speak to those people that had signed on to our website.
Yes.
To go and initially raise the $81 million that we did in December of 2019.
So, Chris, that $81 million was predominantly mums and dads, or sophisticated investors, or family offices? Any institutional money in that?
No institutional money.
No.
It was all high net worth family offices,
yes.
Individuals primarily. So there was quite a wide spread to it. And going into it, the focus was we deliberately wanted to have a diversified investor base. We didn't want to be beholden to two or three larger investors that have got control of the fund, essentially.
Yes.
And so that was very deliberate in terms of how we went about that, and we were quite blown away with the level of interest that we had around that time of the launch, and it was genuinely a humbling experience. Yeah.
Interesting that's one part of it. The other part is the operations and what the funds management business actually is going to represent. So it appears from my research that you made a deliberate decision to keep your business as simple as possible. And I say that because of the following reasons. You've got one fund, the 1851 Emerging Companies Fund. It's long only. It's a diversified portfolio of ASX-listed stocks, no unlisted pre-IPO companies, no short selling, no gearing, no hedging, and your fund is benchmark unaware. It seems very, very simple and easy to follow, and it just seems as a deliberate intention to do so.
It was very deliberate to make it as simple as possible, and to really also, in addition to that, is to stick to what we thought we were good at and where we thought we could add value. I mean, the Australian funds management industry is highly competitive.
Yes. Highly competitive.
And so to try to create a product that we thought was going to differentiate ourselves over time, that was a really important part of it. And simplifying the message, and when we were pitching to people to invest in the fund, they really appreciated and resonated with the simplicity of it. So that was the overarching theme, was to really just keep it simple, where we're going to be a single product business that's going to 100% of our time is going to be on that one product. And we've created a structure with the team, so Martin, my co-founder, and Marianne, who joined us at the outset as our COO, where Marianne was pivotal in terms of taking the pressure off, Martin and myself, where we could essentially just come in every day and just spend 100% of our time managing the money.
Yes.
whereas Marianne would look after all the administrative side with the trustees, the back office and and so that was a really important hire for us.
Yes.
And so Marianne is a really important member of our team, and it certainly creates a good environment, we think, where we come into work and we just purely focused on managing money.
Yes. And it's paid dividends from that respect. With the investors, and Marianne talks to them, or do you talk direct with investors?
We all do.
Yes.
Yeah, Marianne's terrific talking to investors, but we speak to a lot of our investors all the time.
Right.
We have semi-annual webinars, where anyone can register and listen if they're interested. But typically, the investors want to hear from the decision makers. That was another thing that I've learnt through my journey is, particularly at the years at Challenger, where they had, their larger funds management businesses have sales teams or BDMs, but a lot of the advisors and decision makers want to hear it and speak to the actual person running the fund.
Yes.
And so, we are very, we learnt this from Wilson Asset Management, being that business being so good at marketing.
Yes.
Probably one of the best in Australia, I think,
Yes.
in our industry. And so that was really ingrained in us, was, to be constantly communicating with your investor base and tell them what you're doing and tell them what you're doing with their money.
Yes.
I think it's really important.
Absolutely. And you've done a great job at that, because for obvious reasons, and I'll get to that in a moment, your investment philosophy has clearly come from that period of time working with Geoff and then beforehand with Challenger. But I just want to discuss that, because a lot's said about investment philosophies and where you want to place your emphasis when you're investing. Can you just go through a little bit about that? Because it's in the formation of a funds management business, you need to have, it's almost like guardrails, and you know where you're focusing your time and effort. For the listener, I'm personally really interested in what form that investment philosophy right at the start that you could hang your hat on and grow your business around.
I think for me, observing what I have in the time I've been doing this is, in the small cap end of the market, you see the most mispricing opportunities, given the size and the scope of that market. And what we've seen over the last 10 or 15 years in particular is less and less focus on that small cap end of the market. So less research, less coverage than what you had 20 years ago, and it's all concentrated in the top 100. So be able to find mispricing opportunities in that top 100 in the market is a lot more difficult. It's more competitive. You've got, last time I checked, there was 64 analysts covering BHP. So what's your edge? How are you going to differentiate yourself by buying BHP, and why do you think it's a buy? Whereas in the small and micro cap in the market, we can go and meet with a CEO, whether it's here in Perth or anywhere around the country, and have a one-on-one meeting with them and get a deeper understanding about what makes their business tick and what are the key drivers for that business over time. And that sort of shapes our philosophy, being with a focus on growth companies, and they typically only exist, we think, primarily in that smaller cap end of the market. And there's been many that have gone on to graduate into the top 100 over time and be highly successful, like ProMedicus and realestate.com are two that really are top of mind at the moment.
Yes.
So for us, we think that the ability to produce, really strong returns and outperform a benchmark is the setup we think is more fruitful to do that in the smaller cap end of the market compared to the larger end of town. And that's certainly proven to be the case. If you look at the history, the stats tell you that large majority of small cap funds in Australia outperform over time. And that's even more critical these days, where the marginal dollar now is going to more passive ETF type strategies. And so, active funds management's probably under the most amount of pressure it's been on for many, many decades. Pressure on fees, pressure on flows going more to passive as opposed to active like they always have.
Yes. It's quite interesting that you put that philosophy in place, and then you've got the capital raised, you're ready, we're off and running really, and it's February 1st, 2020. Okay? Now, for the listener, that is a pivotal time, and we can tell why in a moment. So Chris is up and running and everything's looking pretty good, fair to say?
We were in great shape.
Yeah.
We thought we were. So we'd spent, 3 or 5 months building a portfolio and going back out and seeing companies again. And for me, the really important thing was we'd raise the money, and the day we decide to start, that we deploy the capital straight away. And, one of the lessons that I'd learnt over time launching other products previously was that we probably weren't quick enough to deploy capital, and it provided an early drag on performance as a result. So that was one lesson, was we're going to be really clear about what we want to buy and when we're going to do it.
Yes.
And so we'd spent time building that portfolio and then deployed the money on the 1st of February of 2020. We thought that would be a good time to start. Markets will be more liquid. December, January, everybody's away, so it's harder to buy things. And we'll go into a reporting season in February where all these company results will come out and provide some volatility and hopefully goes in our favour.
Which is logical thinking. And 3 weeks later, the coronavirus pops up, COVID. I was doing some research, Chris, and I couldn't help but see this article. It was written in The Australian, and this is just not long after you'd started. Stott misses out on 1851 gold rush amid virus carnage.
That's right.
Now, just before I go, I just want to talk about this article, but had you deployed the whole 81 million?
We deployed it all in the first few days of February.
The whole lot.
And one thing that I did before that moment was what would have been the day before that was I spoke to a close contact of mine who essentially consults to the World Health Organization. And I rang him and I said, well, what is this thing? How bad is it? And how do you see it playing out? Because I thought if anybody knows, he'll know. And the feedback was, it looks like it's going to be contained to China. Maybe it's a different form of bird flu, but it's too early to say, but we feel as though it's under control. So I'm like, great. Came into Martin and Hickson in the office and I said, I think we're good to go.
Box ticked.
And so we deployed the money in the first few days of February.
The article goes on. Stott had raised around 80 million for his new business, largely from wealthy families and sophisticated investors like ex-Colonial First State Chief Executive Chris Cuff. Since launch, however, things have gone rather badly. In 2 months, Stott's first foray, the 1851 Emerging Companies Fund, has lost a third of its investors' money. That's almost $30 million. It was down 25.6% in March alone, according to an investment update circulated to clients earlier this week and obtained by this column. For the record, that's substantially worse than the ASX benchmark. I thought, I better just raise that because...
Didn't miss.
Look, it just basically pinned you.
Yeah.
And said, good luck, buddy.
Exactly.
So that's COVID, right? And that's the impact of COVID. And you weren't alone. So that's the market went into quite a dive and you participated in it. Now, just this investment philosophy, everything you'd learnt from the previous global financial crisis, the echoing of Geoff and Matt Kidman in your ears, your gut feel, just talk us through that period, that week or so where you had to make some calls. Did you liquidate? Did you hold? Did you buy more? All those things that fund managers would have had to have assessed.
So what we did reasonably well, even though the numbers don't reflect it, is we did lift our cash weighting to about 30 to 40% in the first week or two of March. But as we know, and as I was saying earlier, through the GFC, small caps are obviously more volatile.
Yes.
And in times of panic like that, they get absolutely hammered in some cases. And so we experienced that. And I remember when the bottom of the market was, which was the 23rd of March, and we'd just gone into lockdown, if you all remember, around Australia.
Yes.
The Prime Minister put us into lockdown. And I drove around to Mum's house one night, I think it was the 24th of March, and she goes, oh, how's the business going? And I turned to her and I said, I don't think we're going to make it. I think it's over. Yeah, we've just lost, we've just dusted a third of people's money, including our own, because we're the largest investors in the fund personally.
Yes.
So we just felt absolutely sick about it. And so I turned to her and I said, yeah, I'm not so sure that the business is going to make it. And that was the bottom. And so what progressed through that period was the market started to rally. After the 23rd, it rallied quite strongly. People may or may not remember, but that last week of March, it was really strong. It rallied, particularly the small cap end of the market, and we were still sitting in cash. And I remember that first week of April, I turned to Martin and I said, you know what? If we're going to go down here, I want to go down swinging.
Yes.
And so we just put all the money in the market that we had into cash. We went fully invested. We bought a lot of stocks. You see those incredible buying opportunities once every 10 or 20 years, like we did in the GFC and like we did through COVID, where you can buy stocks trading near their cash backing, stocks trading on P's of less than 5 times, really high quality businesses that you've known for 10, 20 years that are well managed. So it's just some incredible buying opportunities. And also, one of the lessons that I think we applied well going through the GFs was don't be afraid to buy stocks that are up strongly on a day. So, in the early stages, you're going to get really violent rallies and stocks will be up 5 or 10% on the day. Normally, you don't want to be buying stocks when they're up so strongly on that day, but the confidence seeing that happen in the GFC, and we did it again this time with COVID, was just continue to back ourselves and just take that 5-year view where at some stage the world's going to get better, and the rest is history. The rally that we had was quite extraordinary. We lost, as you say, around a third of people's money in our first 2 months. That was by the end of March. By the time we got to August, we'd made everybody's money back. So we got the unit price back up to $1.
Yes.
Which was a really important moment, I think. And to their credit, a lot of our investors didn't panic. We had 2 or 3 redemptions come through in that period of February and March. A lot of people held on with us and continue to do so today. And so we're very privileged for that to happen. And some of our investors actually turned around and deployed money right at the lows and had a really good run out of it. So we ended up making people's money back by August of 2020. And that period after the 23rd of March, the following 12 to 18 months was just an extraordinary period for the fund.
Yes.
Where it returned, I think, almost 100% over that period. And we had significant inflows coming in on the back of that, to the point where we got to June of 2021, where we said, okay, now the size of the fund's at 300 million, we're going to close it at 400 in the end of August. And we did. We ended up closing at the end of August and finished, I think, with about 415 million, which was something which was way beyond any of our wildest dreams. Going back to when I chatted to my mum on the 24th of March.
What a story.
In her front yard, because we weren't allowed to go into everyone's houses. Yeah.
In her front yard?
Yeah. I'll
so
never forget
let's just look at that time frame. So that's the 24th.
Mm-hmm.
COVID's and the market's bottomed. Until when did you get to 415 million?
August of 2021.
So literally
15 months later.
A 15-month turnaround.
Mm.
One thing that we observe as fund managers is, and it's often said, a fund manager is only as good as their client base. You would have learnt so much about your clients through that period. Tell us a little bit about that observation. What did you take away?
Being the wholesale fund that we are, we're primarily dealing with high net worth and family offices, more sophisticated investors. And so observing how they navigated that period was quite fascinating. Some of them, a lot of them were just holding their nerve so that they held on. There were some groups that went, this is time to go, and we think markets are going to rally, and small caps are where we want to be because that's got the most leverage coming out of this. And so there was some groups that have done really, really well deploying capital through that period. But then on the other side of things, you always get, there were a handful of investors that panicked.
Yes.
And they would call up, they'd be ringing me weekly saying, how's it all going? We're not so sure about this. And so just learning about human psychology was it was just fascinating to see how everybody reacts in a crisis.
You also alluded to the fact that you're one of the largest investors in the fund. So you're very aligned with the outcomes. Do you think that held you in very good stead in terms of that reaction by the client base?
100%.
Yes.
The conversations go, well, obviously the fund's had a terrible start, much worse than we had anticipated and beyond our control to an extent. But where you can turn around and say, well, personally, we are the largest investors in the fund, the staff at Only 51 are the largest investors in the fund. So we feel your pain. We know what it feels like. And I think that's really, really important, not only with your own funds management business, you've got alignment, but we also hold that in high regard when we're looking at investing in companies ourselves for the fund, where the insiders and the board and management have got significant ownership in the company, and they're aligned to make the right decisions, we think, for shareholders over time. So I think that's a really, really important factor for us, is that you create the simplicity of what we've got, the one fund, really simple structure, but also we're heavily aligned with all our investors.
Yes. Well, look, I just wanted to highlight that after that start, I was looking at your website, and your 5-year return is around 17% to the end of October. So over 5 years, generating that on a compound annual rate of return, which I think you'd be pretty happy with.
Oh, we're wrapped with it.
Yeah.
It's been a difficult. We've been going for 6 years now. It's been a difficult period for small caps. Particularly through that period of, as I say, 2021 to 2023 where rates were going up quite dramatically and putting a handbrake on small caps, but they've certainly had a more fruitful calendar year to date so far in 2025.
The other thing I observed, and you alluded to it earlier, was that on your website, it's got that the 1851 Emerging Companies Fund is only open to existing investors only. This capacity issue is obviously now the fund grows organically, returns, compounding on returns, and if you capped it at 415, it's obviously growing from there. Just for the listener, explain your reasoning behind this.
So limiting the capacity of our fund we see as one of our largest competitive advantages, where we differentiate ourselves, as I say, versus the highly competitive industry that we're in. And hunting in the small cap end of the market, our strong belief is that the larger you get, the harder it is to outperform over time. So when you're 80 million, you want to deploy, a percent of the fund into a new position, it's a relatively small outlay, isn't it? It's 800,000. But when you're pushing up to, say, $1 billion or $2 billion, that outlay increases. And so naturally you're buying and selling more of each individual stock in the fund. And that becomes quite challenging at times. And so what we've typically found is our best returning stocks over time have sat anywhere from that market cap range of 200 to 500 million, where they're totally undiscovered, there's no broker research, they're profitable, they've got a good level of insider ownership, they're generating strong cash flow, and we think they've got really good prospects to grow over time as they become discovered by the wider funds management community. And so typically we find that we're early buyers and early sellers in stocks generally. We're still, generally speaking, not good sellers, but where you can find those companies that no one, you go to the barbecue and someone will say, "Oh, what are you looking at, Chris? What's your stock tip?" And I hate giving stock tips because they can only work out one way typically. Is that you mention the name of the company to someone, they go, "Well, they've never heard of it," and that's like that ticks our box.
Yes.
And coming back to the philosophy of, the really critical thing about what we do is, you've just got to think differently. If you hunt with the pack and just follow what everybody else is telling you to do, you're going to achieve an index type return, and that's probably not going to be good enough to build a successful business over time. So we've got a certain model that we build internally that we're constantly checking every month or two, where we give every company that we invest in a score, where where it essentially rates how well discovered the stock is. And so we've had some really successful companies invested in the fund over the last 5 years in particular, where they've gone from no one knows them to complete market darling. And what you typically find in small caps is they go in cycles where they become hated to absolutely loved, and they go back hated a year later. And that's something I did notice in my year out in 2019 was stocks that were market darlings trading on really high multiples. When I left in December 2018, I came back into the market a year later, and some of those companies were completely out of favour. Everyone hated them, and I thought, this is fantastic. Like, these companies, the multiples have halved.
Yes.
No one owns them anymore. So quite simple logic is if you're competing with 100 different funds, if 99 of those funds already own shares in a specific company, you've got one marginal buyer and 99 marginal sellers.
Yes.
So we like when it's the opposite to that. And so, typically they're the ones that take this price higher over time if you can get it right. Mm.
Oh, it's great. Thanks for these insights. It's really good. We look forward, and this is probably more from a macro perspective now, Chris, understanding that you are where you are and positioned where you're positioned in your fund. But, how are you seeing things like with the likes of Donald Trump as president of the US, the interest rate environment, when we look at that and how that's reflected in valuations and that sort of thing? Just looking forward, not specifically, but just your sort of general outlook.
Certainly we think at the moment that the market valuations in the market are quite elevated. The small cap end of the town has had a really good run, as I said, so far this calendar year in 2025, primarily driven on, we believe, on the back of interest rate cuts, not only here but around the world, particularly in the US. That's coming to an end now. So the RBA have said here that rates are on hold for now. Our view is that likely they'll probably go up next year in the second half of next calendar year, which could provide a bit of a handbrake, for corporate earnings beyond that point. And similar experience to the US. In terms of the geopolitical environment, it's as volatile. I don't need to say that to anybody, but it will continue to be that way for a number of years, whilst Trump is the president, in our view. So his unpredictability, it's almost been, it's an expectation now. So, the tariff, as I said earlier, the tariff tantrum earlier this year in April, where the market corrected quite sharply on the back of those tariffs. I think people are becoming more immune now to the volatility of what Trump's got to say and his policies, and so that's certainly we think creating less volatility, but certainly our view is the market's got to come back a bit now before it goes higher again.
Yes.
And we're starting to see that a little bit at the moment, and particularly in some of those sectors like AI and technology look really overheated to us.
Yes.
And so we are positioning our fund more so in those core industrial growth companies, which we think can grow no matter what the economy presents over time. But certainly we think that the geopolitical environment will remain volatile for a number of years to come, and interest rates are typically the driver of where equity prices go over time. So if you start to see the US Fed or the RBA start to tighten rates as we go forward in the back half of 2026, that may provide a bit of a handbrake for equities over time. But certainly if you take a step back and look at how the Australian economy is performing right now, we're probably performing the best we have for a number of years.
Yes.
The housing market across the country is incredibly buoyant. Consumers' sentiment's back up. People are generally spending again. Restaurants are full. And so typically, if we see rates start to climb next year, that might bring that back a little bit. But we think over the next 5 to 10 years, we are in the lucky country, aren't we, here in Australia?
Oh, yeah.
And so we think that, over time we can manage the volatility and move the fund around and continue to be active with what we do.
The interesting part with all this is that regardless of how the political uncertainty unfolds, in the small cap world, you really are going to be to a bit beholden to interest rate environment. Would that be fair to say?
Yeah, typically what we find is that small caps are highly correlated to interest rates.
Yes.
Yeah, that and EPS growth are probably the two highest correlations to what share prices do over time in our view. So, yeah, who knows? I mean, it could easily go the other way. If we start to see a rapid deceleration in economic growth, we may get more rate cuts next year. It's really at a really pivotal time at the moment, we think, not only here in Australia but globally, in terms of the economic outlook for the next few years. So it's going to be a fascinating period ahead as always.
Sure is, absolutely. It's exciting. You're in the markets. That's what it's about.
Yeah, we love what we do. So we continue to plough ahead with the team we've got. Yeah, it's great.
So just a little bit to the left field and more generally, you're the Deputy Chairman of the Sydney Swans Foundation.
Yes.
Yeah, and you've been on the board for a little while now. Did you say 4 or 5 years earlier?
Coming on 6 years now.
6 years, yes.
Yeah.
How have you found it?
Loved it. Yeah. I mean, I think part of when I had my year off and deciding what I wanted to do was there were two buckets essentially. Firstly, to start 1851 capital, but secondly, to give back to the community and society more generally. So there's two main areas of focus for me there. Firstly is the work with the Swans that I do. So I sit as Deputy Chairman on the board of the Swans Foundation and, big passionate Swans supporter. We were chatting earlier about those great the games between Sydney and West Coast going back in the early 2000s, just a fascinating, incredible period, those matches. And so they were so good to watch and not particularly good for the blood pressure, but anyway, really fascinating period and just learn an incredible amount at being inside the club. And people talk about the culture of the place and being able to be in it in a small part and get to know a lot of the key people within the Swans Club has been fascinating. And just in terms of, level of humility, feet on the ground, just really, really powerful culture that they've built there, not only across the senior executive ranks, but filters right down and then obviously to the playing groups for the men's and women's. So really enjoy my time there at the Swans. And then the second bucket, which I was talking about, is with the Westmead Children's Hospital in Sydney. And so we certainly donate, our family donates a reasonable amount of money with them to support the kids' hospital over time. So there are two key, focus areas for giving back.
Oh, that's fantastic. Look, you hit the nail on the head with regards to the Sydney Swans Eagles 05-06 grand finals. I mean, will we see one to replicate those back-to-backs?
Oh, I don't know. I'm not sure if we ever will. But hopefully we do one day and the Swans are on the right side of them.
Look, and outside of that, what else do you do with your sport or anything like that? You keen and you get into the water or you play some golf or?
Keen golfer, like to keep fit as possible, so I do a lot of running and swimming as well, but primarily my weekends are taken up with kids' sport, which I absolutely love. So, my daughter Abby, she's a really keen softball player and does soccer in the winter, and my boy Edward, he's really keen cricketer.
Yes.
And so we're in cricket season at the moment, so my whole weekend is taken up with cricket, and cricket's a slow-moving sport as we know, but I love it. I actually coach one of his teams and really enjoy that. Yeah, it's great seeing the kids out there just enjoying sport and making new friends and just going forward from that.
Oh, wonderful. Fantastic. Well, look, Chris, that's probably not a bad place to wrap it up, but, it's been a fantastic chat. It really has. And look, my observations are you are so passionate about what you do and it comes through in spades and you love it. And it's clearly been a part of your life that you've been driven to do well at, and you've achieved that. And it's no wonder. Your experience and where you've been with Geoff Wilson, with Matthew Kidman, with the whole Wilson Asset Management, sounds like an amazing experience as well. And to be able to just have some time with you to listen to the way you explain things has just been wonderful. So thanks very much for taking the time. On behalf of all of us at Euros Hartleys, thanks for being a guest on Finding the Front. And we look forward to doing it again sometime.
Absolute pleasure, Tim. Thanks for having me along.
Good on you. See you, Chris.
Okay, thank you.
Bye.
Thanks for listening to Euros Hartleys Finding the Front. This podcast is for general information purposes only. Please check out euroshartleys.com for more information. Euros Hartleys holds Australian Financial Services Licence 230052.